Hello everyone, in this video today we are going to learn about the fundamental accounting concepts. In the earlier videos we learned about the golden rules of accounting and what is the definition of accounting. We learned accounting is the process of recording, summarizing, analyzing and reporting financial transactions of the business or individual. It is essential for decision making, regulatory compliance and financial management. Now in this video we are going to be discussing about the fundamental accounting concepts. Okay, so please make sure you watch the video till the end. The video is going to be very important and informative. If you are new to the channel, please make sure you like, subscribe and tap the bell icon. So let's get started. The fundamental accounting concepts form the backbone of the financial accounting. They ensure consistency, reliability and comparability of financial statements. Now, in order for the accounts to be consistent, to be comparative, we are maintaining specific principles which we are going to be discussing in this video. There are 10 principles which we are going to learn today about accounting. The very first fundamental concept of accounting is the business entity concept. Business entity concept. So what the business entity concept says is the business is treated as a separate legal entity from its owner. What do you mean by this statement? Business and personal life are treated as two different entities. Okay, now for example, if I have a bike and if I use it for personal use, I will not include that in my business activities. One more example is the cash that I have at my home is the cash that I use for my personal use. I will not be considering that as a business cash. Business cash is something that I have in a bank account or in the office, which I will be utilizing for my office activities or business activities. So these are two different entities. Personal entity is different and business entity is different. The capital which we are bringing to the business, it is treated as a liability and we are crediting it always. All financial transactions are recorded from the perspective of the business, not the owner. Now the owner does not decide to which account what has to be debited or credited. There should be a consistent way of accounting the business transactions, and that will be done only by following the concepts of accounting which we are discussing right now in this video. For example for business entity concept is if the owner invests around $10,000 into the business, it is recorded as capital and not personal income. Right? Like I said earlier, if an owner introduces $10,000 of capital into the business, we are crediting the capital account and debiting cash or bank, whatever, right? So this is the best example for business entity concept. This has to be followed by every accounting firm, every organization and every business. I hope it is clear. Next we move on to the second concept. The second concept is called as the money measurement concept. Money measurement concept. Now what does this mean? Only transactions that can be measured in monetary terms are recorded in accounting. Non-monetary elements like employee skill or brand reputation are not recorded. Right? So what the money measurement concept says is all transactions which are to be accounted in the business should have a financial implication. I go to a store and purchase something, I will get a receipt from the storekeeper. So that is used as a proof of a business transaction, of a financial transaction. So based on that, I will be accounting that into my business. I will be passing the necessary entries into the business. I will be debiting the concerned account and crediting the concerned account. So anything that apart from financial transactions like in office, suppose say if a senior executive is overshadowing his manager those transactions we cannot account it in business. If the manager is thinking that the senior executive is a roadside Romeo, those things we cannot account it. There has to be a monetary transaction, a financial transaction, for it to get accounted into the business, and that is what the money measurement concept says. I hope it is clear. I hope you are clear with the money measurement concept. Next, we will discuss about the third concept, that is the going concern concept. That is the going concern concept. Going concern concept. Now, what this concept of accounting says is, it assumes that the business will continue to operate indefinitely unless there is evidence to the contrary. So regardless of any unforeseen event, it could be a death of a business partner or someone who belongs to the business, regardless of these unforeseen events, this concept ensures that there is consistency of accounting without getting impacted by any unforeseen events. I hope the going concern concept is clear. Next, we will discuss about the fourth concept, that is the cost concept. Cost concept. It is also called as the historical cost. Historical cost. Right? So what this concept says is, assets and expenses are recorded at their original purchase cost, not current market value. Now suppose say I go and buy furniture and equipments for my business, and today the cost of that furniture and equipments is 10,000 rupees. Okay, 5 years down the line there will be depreciation that will be applicable for these assets. That depreciation will be accounted separately, and we are not considering the current value, the current market value of the asset. So tomorrow when I want to derive the current value of the furniture and equipment, I will consider the original value at which I had bought the asset, and based on that I will apply depreciation. I will not consider the market value of the asset directly. I will derive the current market value of that asset considering the original cost at which I had bought the asset. Right? And that is what the cost concept says. This type of concept is followed to ensure objectivity and verifiability in the financial reporting. I hope the cost concept is clear. Next, we will move on to the fifth concept, that is the accrual concept. Very important concept. Revenues and expenses are recognized when they are earned or incurred, not when cash is received or paid. Understanding? For example, let's take an example of office salaries. Okay, now for the month of March, which is the last month of the financial year, suppose say that many employees have quit their job. They have worked for around 15 or 20 days and they have left their job. So what we will do is, we will account those employee salaries in the month of March and show it as the March month earnings of the employees. We will not wait for April month and then process the salaries and that time do the accounting of these earnings. It is not correct. Then we are following cash basis of accounting. What the accrual concept of accounting says is, revenues and expenses are recognized when they are earned or incurred, not when cash is received or paid. Now the transactions can happen anytime. These March month earnings which the employee has earned, that we need to account it in the month of March itself, regardless of whether when we are paying it in the month of March or April, it is secondary. But we have to ensure at the date or in the month in which it is incurred, we have to make sure that it is accounted in that specific month itself. And that is what the accrual concept says. Accrual concept ensures financial statements reflect the true financial position. Now this is done to derive the true financial position of the business. Now if there is irregularity or ununiformity in following the accrual concept, suppose if you are following accrual concept for 1 month and following cash basis concept for second month, there will be no uniformity in this. So to ensure comparability, we have to make sure that the uniformity of accounting is maintained year by year, month by month, day by day, right? Just a short example for accrual concept. If you provide services in December but get paid in January, the revenue is recorded in December. That is the best example. It's the same example I gave for the for March and April. So I hope it is clear. Accrual concept should be clear by now, right? Then we'll talk about the sixth accounting concept. That is the matching concept. What the matching concept says is expenses should be recognized in the same period as the revenues they help generate. Now this matching concept is somehow closely tied to the accrual concept. And it says that expenses, whatever is incurred for a period of time, it has to be generated in the same period so that we come to know what are the revenues which we have which we have made through the expenses which we have incurred. That is what the matching concept says. Ultimately, the debits and credits have to match and the assets and liabilities have to match. For example, depreciation of a machine used in generating revenue is matched to the periods it is used, right? Depreciation, suppose say for furniture equipments which we had bought, depreciation of furniture and equipments used in generating revenue is matched to the periods it is used, correct? I'm using furniture and equipments for the month of April, so I have to make sure that there is an entry for that specific month during that period of time of usage. The objective of matching concept is to make sure the expenses are recorded, and based on the expenses, what is the income that a business has made in that period, we will be able to derive through all the accounting which is done for that specific period. Then we'll talk about the seventh concept, that is consistency concept. Consistency concept. Now what this concept says is accounting methods and policies should remain consistent over time. Changes must be clearly disclosed and justified. Example, change in depreciation method. Now there are several methods of depreciating assets. There is annuity method, there is diminishing method, reducing balance method, right? So if there is any change in the method of depreciation, that has to be disclosed. That is what the consistency concept says. Then we'll talk about the eighth concept, that is conservatism concept. Conservatism concept, right? So what this concept says is accountants should anticipate no profits but recognize all potential losses. For the best example is bad debts, right? When we have made a sale to a specific customer, suppose say today we have made a sale of $200 to Mr. A, right? So what Mr. A will do is he will receive the goods, he will do the accounting in his system, and after a specified credit period as per mentioned in the purchase order, he will make the payment, right? So in this scenario, we understand that the customer is not going to make the payment for the goods which he has received against a specific invoice. Okay, so then what we are going to do is we are not going to keep it open in the books. We are going to record it under bad debts or doubtful debts, because it's a potential loss to the business, right? We are going to account it as a bad debt, right? Also, the conservatism concept says that revenue is recorded only when it is certain. Expenses are recorded when they are probable. Now, revenue when we are receiving it, that is when it is getting recorded. But expenses, it is not like that. Expenses, like I said, when we are doubtful of receiving a specified amount of money from the customer, we record it as a bad debt and show it in the books of accounts, right? I hope it is clear. Then we are going to be discussing about the ninth concept, that is the materiality concept. Materiality concept. So what the materiality concept says is only information that would influence the decisions of a reasonable user or financial statements should be disclosed. Materiality concept, some trivial transactions may be ignored or grouped, right? So just an example I'll tell you. Suppose say in the balance sheet of this quarter, I have reported the value of plant and machinery as 1.5 million instead of 1 million, right? I have added 5 lakh rupees extra. I have shown 5 lakh rupees extra for plant and machinery when it is actually valued at 1 million. So what the investor does is he goes through the financial statements. He sees that the value of my plant and machinery is 1.5 million and decides to invest in my company. Now here the investor is only investing in my company looking at the value of plant and machinery which I have shown in the balance sheet, which is not correct. Now this is something that is material, right? Now this is affecting the user. Now the investor is a reasonable user. If I am making such mistake, I have to make sure that it is disclosed in the financial statements. If it is undervalued or overvalued, right? I have to make sure that it is disclosed in the prospectus, right? So this is what the materiality concept of accounting says, right? Then we'll move on to the 10th accounting concept, that is dual aspect concept. Dual aspect concept says every transaction affects at least two accounts, double entry accounting, like we have debits and credits. Basis of the accounting equations is assets is equal to liabilities plus equity. Now it is we all know this basic accounting principle that every debit has to have a credit. There cannot be there can be no financial transactions that has only one entry, which is debit or either credit. So every debit has to have a credit, and that is what the dual aspect concept of accounting states, right? So these are the 10 main accounting concepts, accounting standards that are used in the day-to-day accounting activity. I hope you found this video helpful. If you are new to the channel, please make sure you like, subscribe and tap the bell icon. And do comment your questions. If you have any doubts, you can always put it in the comment section so that I can try to resolve your doubts. Alright, so thank you so much once again for watching my video. I'll see you back in the next video.